Good day, and welcome to the DoubleLine Closed-End Funds webcast. Today's webcast is being recorded. At this time, I'd like to turn the conference over to Barb Van Every. Please go ahead.
Good afternoon, and thank you. Welcome to DoubleLine's Closed-End Fund webcast, hosted by Deputy CIO Jeffrey Sherman. Today, Mr. Sherman will be talking about our three closed-end funds: DoubleLine Credit Opportunities, DoubleLine Income Fund Solutions, and DoubleLine Yield Opportunities. Here we can see the standardized performance for DoubleLine Opportunistic Credit Fund, ticker symbol DBL. Standardized performance for DoubleLine Income Solutions Fund, ticker DSL. And standardized performance for DoubleLine Yield Opportunities Fund, DLY. Earlier this year, DoubleLine launched our ETF complex featuring two ETFs. The first is the DoubleLine Opportunistic Bond ETF, DBND. The second is DoubleLine Shiller Cape US Equities ETF, ticker symbol CAPE, CAPE. For more information on either one of our ETFs, please visit doublelinefunds.com, our closed-end fund and ETF section. Couple of upcoming webcasts later on this month, July 26th. We have Andrew Su and Damien Contes discussing our infrastructure income webcast. And in September, Andrew Su will be back with Jeffrey Gunlock on September 15th to discuss the Total Return Bond Fund. To receive a copy of today's presentation slides, please go to the left-hand side of the player and click Request Webcast Content. Be sure to catch DoubleLine's Thought Leadership. On DoubleLine's YouTube page, we have our Roundtable series and Channel 11 featuring portfolio manager Ken Shinoda, which is released monthly. You can follow him on Twitter at DLine Channel 11. We also have two podcast series. The first is our acclaimed Sherman Show podcast with Jeffrey Sherman and Sam Lau. You can follow them at Sherman Show Pod. And our Monday Morning Minutes featuring Sam Lau and Jeff Mayberry, and you can follow them at DLine Minutes. And with that, I'd like to turn it over to our host, Mr. Jeffrey Sherman.
All right, thank you, Barbara, and thanks everyone for joining us today. It continues to be a rough year to date in financial markets, whether that's in the fixed income side, whether that's on the equity side, or really a smattering of assets outside of really just the strength in the US dollar, as well as even some of the strength that we've seen year to date in the commodity complex. Although we have seen some rolling over of the commodity complex as of late, really just exacerbated by a lot of volatility. So as we get into the closed-end funds, which are some of the riskiest products that we run here at DoubleLine, I thought it made sense to really review the macro landscape of what got us here and what's going to be the driver of financial market performance over the second half of 2022. So with that, let me start with what's going on across the globe, and we'll do it with a review of world GDP. And so there's a lot of talk about a global contraction and potentially a global recession, and a lot of that's been magnified upon the US market, which I'll cover in a minute. But looking across the globe, what we've seen is prior to the pandemic, that world GDP tend to vacillate somewhere between 3 to 4% on a real basis. And so why I point this out is that has been the trend line growth really since the global financial crisis. Obviously, we saw the decimation that took place in 2020 with the global pandemic, and we saw the recovery that came back in 2021. And if you kind of compound those 2 years together and put them together, you got a cumulative growth between those two areas of about 2%, or if you call it on an annualized basis, roughly 1%. And so obviously that's below trend. But what we see here, even with the reduction of what 2022 was supposed to be, something that delivered in roughly the 4.5% range, or was economists' estimates really at the end of the first quarter. Now what we've seen is that they've really gravitated back into the low end of that trading range, which we've been in really since the global financial crisis. And so at this stage, again, it's a little early to tell. We'll get GDP in the US. We're one of the early reporters when it comes to second quarter GDP. It'll come out towards the very end of the month, and we'll see what that portends as well. But when you look at 2022 and 2023, what you find here is that we're roughly going back to these trends that we saw. So even the decimation that took place in the pandemic, we had a little bit of recovery on the other side. We overshot to the upside, and we seem to be settling in at or around trend line. And if you look at the economic data and you break it down by region, and I want to remind everyone this time series, what it does is it takes for each region, it amalgamates a bunch of economic statistics and data points and compares them contemporaneously to what has been that experience on average of those data points over the last 12 months. And so when you have a positive number, that means the economic data is outperforming on average where we were over the last 12 months. And when it's negative, it is underperforming where that's been. And you can see here that taking a look at these time series, that obviously everyone overshot significantly relative to those depressed levels from the pandemic, really distorted the scales here. But ultimately, what you see is that all of the economic data right now is slowing. So irrespective of the region, whether you look across the entire globe, you break it down by the key geographic and GDP regions, what we see here is that every single region is underperforming on economic data where it was 12 months ago. So that's kind of the bad news. Remember, that's a relative statistic. But when you start to look at some of the data, what you find is that there's still parts of the globe that look somewhat expansionary. And so what I have on the screen here, it's a wall of numbers. Again, as Barb mentioned at the onset, you can request the slides by going to fundinfo@doubleline.com or sending an email there and requesting the slides. But what you find here is that the manufacturing surveys still look to be somewhat expansionary. Remember, the reference point is 50 when looking at survey data. What that means is that when we look at a number greater than 50, it says on average that more respondents are expansionary than contractionary. They're what we call a diffusion series. So the magnitude really just talks about the number of respondents that are responding in this positive expansionary type of manner. What you find is that if you look at the bottom panel, you notice that there's some pinkish or reddish areas, and that is the contractionary part right now. So when you look at the manufacturing expansion, it still is taking place within the developed market world, but it is somewhat contractionary. At least on average, these respondents seem to be more contractionary than expanding their manufacturing plans at this juncture. The good news on that, if you were to take this and look at the emerging market side, you'll see that the one that it has went into expansionary territory as of late is China. And we all know that China is the big behemoth when it comes to driving the emerging market space as well. So when we take a look at what we've seen here is you've seen this deterioration within the emerging market space all year. It's been prolific. When you look at performance across emerging markets, specifically in the bonds, it's one of the worst performing sectors of the global fixed income marketplace year to date. It's been down roughly twice what you've seen in the U.S. markets. But also, when you look at the developed world, what you find is that it's still expansionary. However, it doesn't seem to be as robust and as strong as we were seeing at the first quarter of this year. So again, something to keep an eye on. There's been lots of talk about a recession. I see some questions in the queue about that. I'll get to that towards the end of the presentation and talk about what we're watching here at DoubleLine. But bringing this back home to the U.S., again, very similar picture, right? If you look post-global financial crisis, GDP tend to really stay between a range. It was roughly, call it like the low 2%, 2.2 to roughly about 3% real GDP growth. Even when we had the greatest economy ever, it was about 3% back in 2018. Again, very similar picture on 2020, the degradation to the pandemic, the overshoot back to the upside. And notice now the expectations in the U.S. have been revised down more than what you've seen really from the global GDP estimates. And so what you find here is that, again, we're going back to this kind of trend line growth. At least that's what the economists are telling us at this point in the cycle. So we'll have to keep an eye out. I know there was a negative GDP print in the first quarter. The GDP now, the Atlanta Fed's estimate of the second quarter GDP is also showing a negative reading. We'll get another update to that data point on Friday. But so far, it does look like that we're going to have a little bit of contraction in the first half of the year. One other thing I like to look at is a time series that the New York Fed puts out called the New York Weekly Economic Index. And so why I like this, unlike GDP, which is only released on a quarterly basis, and we do get those updates from the Atlanta Fed when there's new data to put into their model. But if you look at the Weekly Economic Index, it tends to correlate quite nicely to GDP on a year-over-year basis. And so you can see here that the real-time economic data that's being reported by the New York Fed shows us that we are in this kind of slowing regime as well. So it's very consistent with what the mood and the tone is out there in the economic data, that it's likely, when we get to second quarter GDP on a year-over-year basis, it's likely about to be around 2.5%. One other thing, we like to follow our leading economic indicators. The Conference Board does a good job of putting these out. These are what we call necessary but not sufficient indicators. It's necessary for them to go negative in order to have the recession, but just because it goes negative, it's not a sufficient condition to say that you are in the recession. And so when we look at these lines, we like to look at the 12-month number, the year-over-year number, but we also try to speed that up a little bit by looking at the 6-month rate of change, and that's the blue line here. And you can see here that the leading indicators on the 6-month basis are starting to print negative numbers. And so, again, this doesn't mean that it has to pull that red line down, but you can see that that momentum has been pretty poor within that red line. So again, this doesn't put us on recession watch today, but it is something to kind of alert our antennae and put them up for that recession watch. Another thing, I talked about the PMI data. Again, manufacturing is a smaller piece of the U.S. economy than the service sector of the economy, and so it makes sense to look at not just manufacturing and also look at the service sector as well. So even though it's called a purchasing manufacturer index, really it's talking about the economic activity within those regions, within those sectors, whether it's goods or it's indeed services. And so looking at the manufacturing, we can see the degradation there. We also see what's happened to on the service side, but notice that these are still kind of in their average levels that we've seen post GFC. And so you can see that blue line on manufacturing has dipped negative a few times, didn't pull us into a recession. I think that both of these indicators need to be in those contractionary levels, that is sub 50, and for a period of time in order to really call on the recession. Remember, services tend to drive a fair much more part of our economy than the manufacturing segment. But again, these are diffusion indices, meaning that they're survey data, that they're just talking about your intention of expansion versus contraction, and it's done by throwing out surveys to individuals. So why do I care about this? This is kind of another a measurement of thinking about what current level of economic activity is as managers plan to do their spending. And so I think what's most important right now, it's on everyone's mind, is the inflation. We were told, 12 months ago that this was indeed transitory, the level of inflation. It has since gotten unwieldy and gotten away from bankers around the world. And that's why you've seen the pivot across central banks being extremely hawkish late in 2021 as well as in 2022. And what's very interesting about this chart, I think I pointed out last time I used this slide in a webcast, is that it's really rare for the developed market world to be generating a higher level of inflation than necessarily the emerging market space. And some of that has to do with the EM countries tend to be more commodity intensive, which has a little bit more volatility within them. But it is pretty amazing to see that the developed world is what led this new inflation regime across the globe. And for all the talk that's made about policies, potentially there was, the policies are what got us here, but this idea that it was just a U.S. phenomenon doesn't really augur well with this chart, because this chart's showing you that inflation is rampant across the globe. So when Jay Powell is out there trying to say, well, all you gotta do is hike rates, that will curtail some of the demand function. We can control the demand side of the equation. Well, the problem is that everyone is consuming very similar baskets of things that are causing these inflationary readings. So the world is exhibiting some of the highest inflation we've seen in over 40 years, and it is driven by the developed market as well. So we all have become inflation experts. I'd say even my parents ask me about the level of inflation these days. Maybe that means we've hit peak inflation, and I think we're getting very close to it on tomorrow's print. When we get there, we probably will see one of the cycle highs, absent there being another push upwards significantly in the commodity complex. But if you look, all of the measures are reading still this upward trajectory within the inflation complex. We have seen CPI, core CPI, come down a little bit. It actually is forecasted to come down a little bit on tomorrow's print. But again, these are still numbers that do not make central bankers very comfortable whatsoever. And we all know the story. It's been blamed on the supply chains. There's an index out there created by the Federal Bank of the Fed, the New York Fed, I should call it, looking at supply chain pressures. And you can see here that there has been some relief in the supply chains. We were starting to get this in the first quarter, at least, albeit off very elevated levels. But then what happened is we had the China zero COVID policy shut down, also caused more pain within the supply chain. So we are starting to see some recovery in the supply chain side, which does portend to help bring inflation down, assuming that there's the ability to deliver these amount of goods out there. And so if you break down CPI into its key components, call it goods and call it services. So think about goods are things that we consume. Services are more like the experience side of the equation, although that's not the official definition because housing is also in services. I guess you could say living and having a shelter is an experience. I would call it kind of a necessity, but I'll digress off of that. But what you see here is that commensurate with that reversal in the supply chain bottlenecks, you've also seen a reversal in core goods inflation. So this is a very positive attribute. This has been stubbornly high. This is something that personally I thought it would reverse sooner in the complex and transfer to services a lot sooner, roughly a year ago or so. But we've seen both remain relatively elevated. And you can see here that services is starting to really start to gain its traction and move in an upward trajectory. And so the bad news about that, as I mentioned, is that services just isn't the experience. It's not just the elevated level of travel. It's not just the leisure components, where that's hotels, fuel when it comes to recreational. One of our colleagues just took a trip in an RV and was trying to make the case to me, well, it's fuel efficient. I have a diesel. And we all commented, have you seen the price of diesel? It tends to be higher than actual petrol prices. But that being said, what you find on the services side is a key component here is housing. And so if you look at rents and what they've done on a year-to-date basis, this is the month-over-month change. So you can see that once landlords had pricing power back, they took advantage of that in 2021. There is some seasonality that kind of creeps into these indices. You can see that rents tend to soften up a little bit on a month-over-month basis as you get into the fall and winter months. However, what you see is that we've resumed this increase of 1 to 1.5% in terms of rent growth. So this will continue to put pressure on what's called the owner's equivalent rent. So there's rent and owner's equivalent rent in that marketplace. The owner's equivalent rent will be tied more into the housing side. We all know the story behind housing. Housing continues to print extremely elevated levels in terms of its year-over-year price growth. We do not think this is tenable. Obviously, with mortgage rates going up, there is going to be some pressure on house prices, especially in some of these areas of the market. We do not think that this portends for a collapse in house prices. We think there's obviously certain markets that are a little bit vulnerable, but remember how much house price appreciation you've seen in the collective market over the last 24 months. And so when you compound this out, you're talking about a 35 to 45% 2-year cumulative growth rate in house prices in the major metropolitan areas. So again, this is something where even if there was a little bit of softness in these markets, prices tend to be a little stickier to the downside. But still, this is going to remain elevated, which means it's going to continue to keep that pressure applied to the services component. So again, this is something that's beyond the scope and control of Jay Powell. Remember, mortgage rates aren't the only thing that dictates the price of housing. For all of America that has a 30-year fixed rate mortgage today, what you find is that they're not influenced by what's going on with the change in mortgage price. It's just if you need to transact, so it's that marginal buyer we're talking about. But also, when we look at the input prices, there's something called PPI, which is a producer's price index. So think of this as more input cost into the equation. And you're starting to finally see some year-over-year decrease. That's that blue line that you see there. We also include the green bars in there. And notice still at 80 basis points, we got a decline. That's because it was such a high reading of more than 120 basis points roughly 12 months ago. So you're seeing a little bit of deterioration in this series, which is a positive thing. Year-over-year input costs coming down can also lead to having some cap on some of these inflationary behaviors. So this is a very important chart to watch as we look through it. There's another thing that we like to look at too, inside of these ISM surveys, is something called the prices paid component. And so again, this is for achieving things through your supply chains, what are you effectively paying for things? And so what you see here is that blue line is the prices paid indices. So again, it's a diffusion index. So it's again telling you how many of your respondents are saying that they're increasing the cost. So it doesn't give you the magnitude, but you can see that it correlates pretty decently to this red line. And that red line happens to be headline inflation. And here we're showing it with a 4-month lag on the data set. It just seems to, again, input costs, they have to go into the supply chain. They come out on the other side of manufacturing. You ended up getting the end of the finished goods. And all of a sudden now that leads into, if there's consumption, the CPI component. So again, we think that this augurs for a little bit more relief too on the good side of the equation when it comes to the inflation data. So good news is, Jay, there's a lot of metrics out there that are working in your favor. I don't think it's attributed to the interest rate policy we see thus far, but I'm sure Jay and his colleagues at the Fed would take a victory lap irrespective of how inflation comes down. So what does the bond market think, right? We all know there's elevated levels of inflation. I hear this from clients all the time. Well, we have an 8-handle inflation. Why are treasury yields across the curve yielding roughly 3%? And that's because the market does believe, indeed, that inflation is transitory. It's just transitory on a different time frame than potentially that Jay Powell told you about originally. And so the bond market thinks over the next few years that inflation will start to gravitate towards a lower 2% range, which is the Fed's target. So you see here what we have is something called the zero coupon swaps curve, inflation swaps curve. What that does is that essentially says what makes you agnostic to between owning the tips and well, that's the break-even rate. But effectively, this is the way to trade inflation and make a bet on inflation. So the market has priced this in. But notice 1 month ago where inflation expectations were for 1 year versus where they are today. They have changed massively, 186 basis points. Now, fair point, a caveat there, I should say, is that there is some seasonality in inflation. And so again, that 1 month roll-up does something to do to that. But more importantly, notice across the curve, rates have come down significantly, the expectations of what the price of inflation should be. And so again, if you think about this, you could say, well, wait a second, I don't see anything gravitating down to that 2% rate. Well, what you see is that, remember, you have to compound this out. So if you think that inflation in 1 year is now going to be 4%, but over 2 years, it's going to be 3.5%, that says in year 2, inflation is roughly 3%. So the idea here is that from looking at this curve, the market thinks we're going to get back to these 2% inflation rates roughly in the next 3 or so years. Again, something we've been talking about, that inflation probably remains elevated above the 3-handle through 2024, absent some significant recession. But again, you're finding that the market is starting to gravitate this and saying a lot of this inflation behavior seems to be behind us. Again, that's the price of the market. I mentioned break-even spreads. It's another way of looking at this. Break-evens, I said this wrong on the inflation and swap side, but break-even spreads are what make you agnostic, what inflation rate makes you agnostic between owning current tips versus the on-the-run treasury market. And notice here what you see, the 5-year break-even has diminished massively. We've had over 115 basis point rally in break-even spreads over the last 3.5 months. And so the market's starting to get some of this inflationary behavior behind it. And so I say, okay, maybe the risks are more balanced. It's not as much just an inflation, but potentially there's some deflationary risk or disinflationary risk out there as well. And when you look at real rates across the board, this is something that's very important for thinking about equity multiples, right? Equity multiples tend to be correlated highly to the direction of real rates. So when real rates are going up, multiples tend to go down and vice versa. What you see here is that outside of Japan, real rates have continued to push up across the entire globe. And Japan is committed to a different policy than the rest of the world. This is why you've had a significant devaluation within the Japanese yen, is that essentially they're sticking to a policy that says they don't have any inflation, they're not worried about it, they're not worried about the strength of their the deterioration of their currency, and they're not following along with the rest of central banks around the world. So there's a disconnect between those markets, and again, it's because of the differentiating policies between those central banks. Lastly, what's very important when you think about the health of the economy is employment. And one thing that you can criticize about the employment rate is that one, it defines some people out of the workforce, which is why I include the U6. This encompasses the underemployed as well. Notice what you see here. The red line is slightly above where we were pre-pandemic levels. It's the official U3 unemployment rate. But if you look at the blue line, we're very close to where we were on the underemployment rate as well. So that takes the unemployed plus those who are not kind of punching at their full weight. And so if you look at this, what you see is that the jobs market is relatively healthy. The employment picture is robust. The downside to this is that we know that the labor market can be a lagging indicator, right? You've seen this too. We've seen quit rates be significantly high. They've been quits for the right reason, where people think they can get better employment. So continue to watch the unemployment claims, I think, as a precursor for what's going on within the employment picture. Remember, we only get the jobs data on a monthly basis. The jobs data was good enough to get the Fed to hike, and they will hike at the end of this month as well. I'll talk about that when I get in the Fed section. But what I mentioned was unemployment insurance benefits and unemployment claims. And this is a time series you get every single week. It gets reported on Thursday of every week. And when you get this data, it's usually on a 2-week lag. So it's more timely than what you see within the employment reports, or what we call the jobs report. But you can see here that those blue lines really are back to pre-pandemic levels, and there doesn't appear to be any trend except a sideways behavior. So at this stage, at least people who are being laid off or let go or quitting aren't applying for unemployment insurance. Then again, maybe those are being able to place in some of those jobs. So I didn't include the job openings data. We all know that story. There's significantly more people looking for employees than there are actually workers out there to be able to fill those out there. And so the recovery has been very sharp in this cycle. If you look at the job as diminished versus where we are today, we only have 500,000 fewer people employed than were pre-pandemic. And you could say, well, that doesn't sound like a very healthy recovery. Some of this is by choice. Remember, that's part of, if you see the decline in participation rate, especially against certain demographics within there. But if you notice in the global financial crisis, how long did it take to get back to the same number and the same level of people employed? It took roughly 4.5 years. So we're doing this now within a little over 2.5 years. And I would expect potentially, assuming we don't go into a recession, that in the next few months, let's say by Labor Day or so, by that September report, we will have a similar level of employment of where we were pre-pandemic levels. So again, this is it can be a lagging indicator, not a leading indicator, but it is very important to watch the health of this. And I see there's questions in the queue about a recession, and it's very hard for us to have a recession without a degradation in the employment picture. People need to lose jobs. The unemployment rate needs to go up, and it needs to change the income component of what's going on. So on that front, looking at the income component, wage growth continues to be extremely high relative to any point since the early 80s. And so again, this is not what's driving inflation, but I think this is a second order effect of some of the inflation and with a tight labor market, that people have to compete for some of these workers today. And so you see this both in the average hourly earnings as well as at the Atlanta Fed surveys as well, which encompass the people it compares the same worker to where they were 1 year ago. So it adjusts for the makeshift in that labor force. So I think the most important picture right now is to watch the labor market. I know that we're seeing some conflicting data we're seeing some slowdown in the economic data out there. But to me, as long as the employment picture is strong and that the labor market continues to have power, that we will not enter into a recession. It may be a technical definition of some contraction in GDP, but that's not how the BLS defines it. I know there's a heuristic that say 2 consecutive negative quarters is a recession, but that's actually not how the BLS defines it. So what has this done to markets? I know we've all felt a lot of pain in financial markets this year. If you just take a look at what's transpired within the global fixed income marketplace, it just hasn't really been a pretty environment. And so this performance is as of last Friday. And you can see here, government guaranteed bonds in the U.S. have lost somewhere between 8.5% and 9.5%. If you buy corporate bonds, they're down another 5% or down 14 to 15%. The high yield market, which was a darling through the first quarter of the year, having significantly less interest rate risk, started to show some cracks in terms of spreads. And we've seen some deterioration there now, where the higher quality high yield has outperformed the investment grade market, and the lower end is really started to reprice meaningfully. I mentioned emerging market debt, that's EMBI, down 20% in dollar terms on a year-to-date basis. That includes more sovereign debt than corporate. If you just focus on the corporates, down about 14.5%. So all of these traditional kind of credit markets that you look at, or maybe they're not completely traditional, but more in these corporate and sovereign markets, there's been a lot of pain across the board. As we move into the securitized space, you can see here that the securitized markets have fared better. Also leveraged loans, which are floating rate, have significantly less interest rate components. You can see that in the darkest blue, black color. Again, it's tiered by credit quality. Higher credit quality has done better. You don't see that specifically within the IG market because of the single A cohort, but in general, this is a story about higher credit quality doing better at this market. Perhaps people are concerned about some of those slowdowns we looked at from the economic data. Talking about securitized, you can see here, ABS market down 4, CMBS market down about 8.5. If you look at CLOs, again, repackaged bank loans, they've done better at the higher part of the capital structure. In the middle to lower tiers, they've done worse than the aggregated loan market, which you'd expect from the way the structures work. So legacy, non-agency RMBS continue to be one of the bright spots there. A lot of this is because these are legacy assets that trade at a significant discount. The bonds do, and so when these loans are repaid at current market prices, you get par back. So where a lot of people didn't think there was upside left in those securities, because of the strength of the housing market's done well in that side of the market. So that's been another kind of bright spot within the market. The yield story, it's not just a U.S. phenomenon, just like the inflationary environment. You look here, almost every single market that we cover here has had a rise in yields. If you feel it's bad in the U.S. with 148 basis points increase in the 10-year, imagine what it feels like to be in these other regions as well. Things that did not, or regions that did not have a significant yield to help offset some of this. So that's why the global market's down significantly more. So the bond market has listened to the Fed. The Fed pivoted, as we all know, back in December. They really started to change their dynamic in March. And what we've seen here is we've seen a 25 basis point hike followed by a 50, followed by a 75. I don't think this is going to be like a Fibonacci series where they're going to hike 125 basis points next time by summing the last two meetings. But I do think that the market is priced for 75 basis points, and that's what the Fed indeed will deliver. But what you see here in the red area is what's implied from the Fed fund futures market about the path of interest rates. And you can see here that if you look at this over time, there was a point where the market did think the Fed got to about 4%. And that was very short-lived. That was back a couple months ago, when the inflation data was reading significantly higher. However, if you take a look at what's happened as of late, it's been about 3.5% is that kind of peak or terminal rate, as the Fed calls it. And this 3.5 rate has been roughly what the market's been pricing in. It's just the path at which it gets there. So 6-8 months ago, it's like, okay, the Fed's going to get there. They probably get there by the end of 23. Now it's that they're going to get there in early 23 or at the end of this year, and then they're going to likely have to retrench. Now, this is a betting market. This is people placing this. These are forecasters. These are people putting on their trades in the market. So it's got the same caveats as any forecasting market, that the bond market is just as bad a forecast as any other market. But it does say that the Fed is going to have to relent and cut rates as well. So that's this push and pull we've been talking about really for the last 18 months. There's the push of inflation, pushing yields higher, pushing the Fed to be more aggressive. Then there's the consequences of the slowdown, the degradation in some of the economic activity, and therefore that's pulling kind of rates back down again. We'll have to see what the market holds, but roughly there's another 175 basis points of hikes priced into the market over the rest of the year. And if you want to know the path, that's 75 in July, that's 50 in September, and then in the November and December meetings, or maybe it's like late October, I can't remember the calendar, I think it's late October, and middle of December, there's 25 priced in as well. And there's kind of the wild card, it depends on the day of the week, maybe there's another 50 in one of those two markets. So the good news is the front of the curve has felt a lot of the pain. The bad news is we still think as the market reprices some of this, there is potentially more pain to come. But the good news is the back end has held up relatively well relative to the other parts of the curve. So there's a question in here in the queue asking about the shape of the curve. I do think, and we believe, that the curve will invert, and it'll probably stay inverted for a meaningful amount of time over the next 2 quarters. And that's because the Fed is going to continue to be aggressive on the front end. We're going to get to where the 3-month T-bill is getting close to the 10-year rate after the next level of hike. So if you delivered on those, the curve should indeed invert. And so, again, does that portend a recession? Historically, it has. But at this stage, we don't see the recession still occurring in 2022. So I think this is the most important chart out there as we look at kind of what's going on with the Fed. It's not just the interest rate hikes that the market knows how to price and has done so, but it's the balance sheet. And so there's a dotted line on the screen. That dotted line is the Fed's target rate and the amount of securities that they'll let run off their balance sheet in a given month. And you can see that it's roughly 30 billion today. It jumps up in September to be 60 billion a month and expected to go on ad infinitum. But what you see here is that the Fed really only needs to do this, have the 60 billion a month, really through the end of 23. And that's assuming that they can get there without causing any market pain. Because at that point in time, really there's not a lot of bonds to be able to roll off on a given monthly basis. This only focuses on the treasury component of the balance sheet. It does not include the mortgages. And if you look at what the Fed's been able to do to date, since the beginning of the month, they've reduced about 20 billion of exposure, which really correlates to what's on the treasury book and really nothing meaningful on the agency mortgage side. So some of that has to do with prepayment speeds, amortization, what coupons that the Fed owns. There's a lot of details within there. But the point being here is that this is something where the market needs to be able to absorb the supply of bonds. And so, again, it's not the 184 billion that rolls off in the month of August, but also just looking at what the roll off will be off that dotted line. So what's happening in the rates market? We have 2s, 5s, 10s, and 30s from going upper left to the upper right, bottom left, bottom right. And you can see here that pretty much the peak in rates occurred thus far all around the same time. And this happened roughly in April of this year. It happened right around the Fed meeting too, with that shock CPI print that ultimately people thought that inflation was supposed to decline significantly. And so you can see here that the peaks have been very similar. You can see that the long bond actually didn't get to its highest level in the last 5 years. That's back in 2018. The long bond, I think, has been a holdout here, whereas it's a part of the market where if indeed we are having some recession, or we're going to have a recession and there is a significant risk-off event, that the long bond is one that we do believe can give you a 20 to 30% return. So I think there's a lot to be said about why the long bond has behaved how it is. And so where we want to overlay duration on our portfolios, we've done so at the back end of the curve, not the front end of the curve, which I do think that the 2-year will push higher and we will see a higher level of rates than we've seen thus far year to date. What has this done to credit spreads? Credit spreads have widened across the board. This is just looking at the last 1 year, but you can see here, it's a little over a year, 13 months. But what you see here is that spreads are roughly at the widest levels that we've seen over the last 13 months. So it hasn't just been a duration component. Even in the investment grade space, you can see here that spreads have widened. That's why they've underperformed the other parts of the market. They have a little bit longer duration interest rate risk. But you can see here that now triple C spreads actually do deliver a spread of over 1,000 basis points. So all in all, the markets are starting to get to where they're more on average, either at average of fair value that we've seen over the last 10 years, or they're cheaper than fair value, meaning that the spreads have gotten wider. The thing I warn people with about this, something we've been discussing in our internal investment meetings, is that there was supposedly all these buyers at certain levels of yield. And we keep talking about it because in the high yield market, it was supposed to be 6, and then it was 6.5. And each of these levels, we've seen a little bit of rally. But then when the market said, oh, there's buyers at 7, we blew through that 7 very quick. And next stop was 8. Today, the high yield market yields about 8, 8.5, depending on which of the market indices you use. So it's starting to get to a level where the yield makes some sense. And if you think that defaults are going to be somewhat curtailed, they're going to be reasonably managed, it's going to be a concentrated recession or potentially just a slowdown in certain areas, it does look like it does offer a positive total rate of return on a multiple year horizon at this point. Speaking of default rates, there's the high yield default rate, extremely low. Caveat is this is obviously a backward looking indicator. Expectations are somewhere between 4 to 6 over the next 12 to 18 months. And so if that's the case with kind of below average recovery rates, it does say that high yield bonds can potentially get you 4 to 5% per annum over that period. So again, something that looks relatively attractive, but if you juxtapose it against what you get in yield and investment grade, and assuming that you have an infinitesimal or small amount of defaults there, they give you comparable ratings, so or a comparable loss-adjusted yield profile. So potentially, that high yield spreads need to widen a little bit more to attract buyers. On the bank loan side, too, we see default rates are about half of what we see in the high yield market. Typically, they run somewhat pari passu with one another. We do expect loan default rates to tick up in a similar manner to the high yield market, although, again, the higher quality and the higher rated bank loans do still look relatively attractive. The securitized brethren of the loan side is the CLO market. Again, this was a darling child of the market, having limited interest rate risk in there. You started to see some collapse in the prices here and some sensitivity. Nothing like what we saw in the credit problems back in 2015. That was more of an energy-related complex as well. The commodity crash that we saw back then. But then also you can see it. This is went across the entire capital stack as well. So AAA spreads now are about 200 basis points on this paper. High quality assets with a coupon that's likely to go up over time. Plus, you get a little bit of a discount in securities. So we still like the CLO market. We think there's interesting things to do. It's hard to acquire things in the double B space. It definitely has recession risk. If you think about the double Bs and the triple Bs and above, we like that part of the market as we think the structure gives you enough protection against a significant default experience in the marketplace. Commercial mortgages, when you look at these, the AAAs, they tend to be more duration related than necessarily credit risk. As you get down into the triple Bs, they tend to be more credit focused. So you can see that there's a different dynamic. Things are trading in roughly the same area, but you can see here the pain point. You had an average dollar price of 110 on AAAs down to 95. So that's 15 points right there that have happened just from price deterioration. And again, that isn't because of credit concerns. That's more the interest rate component. The stuff we're buying in the closed-end funds don't look like this. They're very credit-sensitive assets, and they are low in the capital structure. Lastly, one thing to look at is the EM market. If I look at spreads here, they've definitely got safely above average. We tend to say that 350 is the average. Things look rich at 300. They get cheaper at 400. As you're well aware, in most of our funds, except DSL, which is an emerging market focused fund, we've cut some of our EM exposure the last couple of years. The EM portfolios, I'll talk about the portfolios very shortly. What you've seen there is that there's just been really this repricing of the global rates market. There likely are some jitters about the Fed's quantitative tightening path that they're doing, as well as just overall tightening interest rate policy across the entire globe. So emerging markets are starting to look interesting from a valuation standpoint. However, the technicals are still very poor. It's very difficult to trade in these markets today. Things are just, dealers are just, market participants are just hitting bids on securities out there. It's kind of a sloppy market right now. And so we haven't wanted to really step into more of this trade at this point, but it definitely does look cheap on a valuation standpoint. And then lastly, as I mentioned at the onset, one of the spectacular performances of the year is the dollar. You can see here that we broke out some new highs here from President Trump era when his election took place. That was one of the highs. We got back there again during the pandemic. And then all of a sudden, we've now exploded as the rest of the world isn't keeping pace with the hiking path that's expected of the Federal Reserve. So we did cut our dollar-denominated our non-US dollar-denominated exposure across the majority of the firm earlier this year. We continue to be on the sidelines waiting for an opportunity to jump into this trade. But again, we'd want to see some deterioration there. Again, just some, if you look at the Dixie itself, which is this, a lot of this is the yen, but also remember that the euro is getting close to parity with the dollar right now, as the ECB now they're being tested if they're actually going to be able to deliver on some of those rate hikes that were being priced in the market about a month or so ago. So with that, that's kind of the landscape of fixed income. It's been ugly out there. How does that translate to the portfolios? If you look at the opposite credit fund, this is our first closed-end fund. You can see here the decline in prices has been roughly, it's commensurate to what we saw. It's about 2/3 of what we saw during the pandemic. And a lot of this really comes down for just a repricing of yields. Looking across the portfolio, we feel that the securities we own are securities that do have the ability to generate a high total rate of return across the portfolio. And we feel very good about the loss adjusted assumptions within that market too. So we've had a little more volatility than the ag for a levered fund. That's pretty good. We have, there are some questions about the leverage. We have brought our leverage roughly in line to about 15 to 17%. That's what we've been vacillating between in this portfolio for the bulk of the year. We're looking to add some credit on some weakness out there, but at this stage, we're very comfortable with how the portfolio yields in the distribution. All three of these closed-end funds today have yield to maturities that are in the double digits. So we think that even though that there has been significant deterioration in some of the price of these assets, we think they offer a significant opportunity there. And we're doing so in DBL, for instance, with a very, very low level of leverage. And when I say 17%, I'm not talking 40 Act leverage, I'm talking about borrowing 17 cents on the dollar. So for a dollar in the fund, you have $1.17 into the overall portfolio. Looking across the portfolio, by prospectus, this needs to have at least half the portfolio in mortgages. You can see here that we've been favoring the commercial mortgage market. This looks nothing like, as I said, those higher quality parts of the CMBS market. In some cases, these are BP securities, which is the low end of the capital structure. What we've really been focusing on these portfolios are single asset, single borrower deals that are really just underwriting the specific credit risk of one property. And so we think building a portfolio of those is better than having a lot of exposure to the broad CMBS market, although we still have about 1/3 of the CMBS exposure in conduit deals, kind of in the middle to lower part of the capital structure that give us some opportunity set. The CMBS portfolio, again, on a levered basis, yields double digits. It's one of our kind of favorite areas in the marketplace today to take that credit risk. If you look at the non-agency market, as I showed, one of the better performers in there. This portfolio has been something that's been kind of a rock within there over the years. It is some of the lower end of the weightings that we've seen. We got down to about 10%. We're about 13 today. And that market continues just to really grind along. So we have no concerns about the risk there. The agency mortgage market, this includes longer duration assets to get us to some of our duration targets we're looking for, as well as things within the CLO market that we find attractive on the derivative side. We do have a little bit of treasuries in here. This is to flatten out some of the convexity on the mortgage side. It's also just as kind of that deflation risk or recessionary risk within the portfolio. So we have a little bit of that there too. The bank loans and CLOs, roughly 40% of the portfolio. This is the floating rate aspect. We think of this as a way of helping neutralize part of our borrowing costs, right? So if you think about the leverage, we only have 17% borrowed, but our leverage is a function of the front of the curve. And so some of that helps come out here. We also use the CLO bucket because we have to have a certain amount of investment grade securities. A lot of the CLO positions will be at the BBB area. So it has a nice, what I'll call the NIM, the net interest margin, if you look at the CLO assets versus the borrowing costs that we have there too. So that's one way we think about that too. We have a small piece in emerging markets, not really much. And there's a little bit within the ABS market as well. So I'll talk a little bit about those when we talk about the other portfolios. So again, lastly, durations, 3.7 years, significantly lower interest rate sensitivity than what you see on the Barclays US aggregate, which is about 6.4 these days. But when you think about it, as I mentioned, the government securities and some of those agency CMOs are giving us longer key rate duration. So our duration is more poised to the back end, and a lot of the credit we're talking about is keyed off kind of that front to belly of the curve. So there is a little bit of risk there to some of that 2-year forecast. DSL Income Solutions, I mentioned this is more of our emerging markets fund, supposed to be a global fund. It has a high significant amount by prospectus to emerging markets. We have continued to continue into that trade. You can see here that even with the pain, there still has been a positive rate of return. There's a question out there that says over the last 5 years, the returns of these funds have been relatively flat. But if you actually look over the last 5 years, DBL and DSL have both been positive. They have outperformed the bond markets by roughly 150, 200 basis points per annum, which is, I know that the leverage cuts both ways here, but if you look at DSL today and you look at the yield profile of this, you would see something that yields in the high teens. Now, there will be some defaults in some of the corporate assets we own, so maybe it's kind of a mid-teen type of yield today. But when I look across this portfolio, it looks very attractive from where the pricing is today to that yield opportunity set. So Income Solutions has felt the most pain on a year-to-date basis, and rightfully so, having that exposure over to that EM space. It's actually done better than just an outright EM portfolio. And this leverage here in this portfolio is about 38 cents on the dollar. So that's some of the lower level that we've had. We tend to run between like 37 to 45 cents on the dollar. We've just been taking the cash flows, reinvesting them kind of in higher quality assets. And we did pay down the leverage and back in after we got a nice little risk rally back in April as well. So again, thinking about the emerging market opportunity set, it looks very attractive today. You can see it's about 40% of the portfolio. Again, this was designed to be that type of portfolio that's supposed to take advantage of the global landscape. And if you saw the yields within the emerging market portfolio today, you'd see why we like them. Even on a loss-adjusted basis, writing these assets down, the bulk of the portfolio on the levered side yields north of 20% today. So this is not a risk-free portfolio by any means. It does have significant amount of EM risk within it, but given the pricing of the market, it looks very, very attractive. So that's why we continue to maintain that part of the market. This was set up to be a more credit-sensitive fund, hence the high yield in loans. You can see that kind of from the pricing. That's why there were some challenges in the last couple of months as there's that repricing of the high yield loan market. And you can still see, once again, the part of the market that we like the most, the CMBS market, very high allocation, like the most within the securitized space is here. You can see CLOs. These CLOs, again, same kind of concept there. These tend to be triple B and double B, so they do have a little bit more risk. But this portfolio yields probably on a loss-adjusted basis 50 to 60% more, not absolute yield, but more yield than DBL. So there's a difference in the qualities of the portfolio. There's a difference in the risk profile, but this has probably 1.5 times the loss-adjusted yield that you see within DBL today. And that is accounting for a fair amount of losses within the overall market. So again, Income Solutions, we think for those that are looking for risk, does look like an interesting opportunity today. Again, it's not without risk. It has a significant amount of risk. You have the EM risk, but we think a lot of that has been priced into the market today. And then lastly, our most recent offering, DILI, as we call it internally, DoubleLine Yield Opportunities, DLY is the ticker. Unfortunately, this one now has a negative rate of return since inception. This one also has a yield profile that's in the double digits today. When I look at this one, it sits between the yield profile of DBL and DSL. It's about halfway on that spectrum, so it yields about 1.25, which you'd see inside of DBL today. This has a higher focus towards the securitized markets. Again, very credit-sensitive fund. That's the way this was designed to be. You can see that we launched right before the pandemic. It was a challenging market to be into. We were able to play some of that recovery, and we've seen just that repricing of credit risk across the board. So now when you take a look at this, you'll see it's much more split out. So those of you that were tuned in early on or before the webcast and got to see the thought leadership pieces at the beginning, I hate watching myself on television, but I did see it out there where I was recommending a diversified portfolio of credit. This is what I mean by a diversified portfolio of credit. You're not wedded to one single part of the market. Yes, all credit has been weak and sensitive this year. Once again, you see we have a high overweight to commercial mortgages here. We still have the CLOs. These tend to be triple Bs and double Bs. They're about 50-50 in the stack between those two. A little bit more allocation in the other two funds in ABS because of securitized focus here. We once again have non-agencies. We do not have non-agencies in DSL for that kind of risk profile out there. There's a little bit of agencies in here. Those are not run-of-the-mill agencies. They're CMO and derivative structures. But we do still have some of the high-yield bank loan and EMD markets. So if you're looking for credit risk today versus making a bet on one single part of the market, this is the way that we think that approaching a diversified credit portfolio should look today. If you like the cheapness of the EM market, I think DSL is one to really take a look at this point, especially given that yield profile I mentioned today on a loss-adjusted basis. It looks like it's got significant potential, not just to not be able to really lose money over the next couple of years on a total return basis, but also the ability to have significant upside once we get some stabilization in markets. So the portfolios carry quite nicely. Leverage in this portfolio is about 30 cents on the dollar. It's kind of on that lower end. It's roughly what we target on this strategy as well. And so with that, let me wrap up my comments on that, and I'll start with the Q&A since we're sitting on 1 hour right now. So lots of questions in the Q&A. I'll have my compliance folks flip to the slides so you can see the rest of them. Let's see. I addressed that question about the 5-year results. Someone's asking about the approach to investing in leveraged closed-end funds with the hawkish short-term interest rate via the Fed. Great question. Something we think about. One way we try to offset some of that, as I mentioned, is using some of these floating rate exposures like the CLO market to help offset the cost of our leverage. So, for instance, today, I mentioned AAA CLOs, although you wouldn't want to put a lot of these in there because they don't generate enough yield. But if I go out and buy AAA CLOs and they have a discount margin of 200 basis points, so let's just say they yield SOFR plus 200, and my cost of financing is SOFR plus, call it 80. All of a sudden, I have what's called a NIM, or a net interest margin, of 120 basis points. So every time I do that trade, if I borrow money and just put it in there, that increases the yield of the overall portfolio. And if you think about that too, it doesn't have a lot of risk. Now, where you run into trouble is if that, let's say, you use a single asset, single borrower deal from the CMBS markets, floating rate, it's single B rated, it has a lot of credit risk. So you can have that degradation there that doesn't help offset it. So when I look at leveraged funds, what I want to know is what's your NIM, what's the net interest margin, what are you earning on the portfolio relative to borrowing cost, right? And how do those things move through the cycle with one another? So the good news about the SOFR rate is, a lot of it, you think about the forward curves and what I showed you in that price in the market, it will hit on the reset when they go up, but also we have a lot of securities in there to help neutralize some of those movements. So great question. What I'm concerned about is those that have tight NIM. So that's why you've seen, let's say earlier in the year, the closed-end muni market really get hit as you start to look at things. And so it's because there wasn't a lot of that spread in there. So again, it's all about what you earn relative to what you pay. And some of that is priced into the market. Leverage, I talked about that, how we've managed it. Does the Fed back off rates if we see a negative 2Q GDP print? No. The Fed is hiking. They told you they're hiking. They're damming the torpedoes. They're going to talk about the strength of the labor market, and they'll ignore that print. So typically, the GDP now has never recovered more than 150 basis points this late in the period. So it does look like, if you believe the GDP now model, that it will actually have 2 consecutive negative quarters of real GDP. But I think the Fed dismisses it at this point. They're going to talk about any other thing that's positive because they are hell-bent on tackling inflation, even though a lot of it's outside their control. If you want a good discussion on this, just had a podcast this week with a gentleman by the name of Michael Green. We went through all of this and talked about it. I think it's very interesting. So timely for those of you that have about 10, 15 minutes to listen to that. So this one's addressing by name. Sherman, how much higher do short rates need to go to start causing distribution cuts for high leverage CEFs, closing funds purely due to interest expense? It's all about that NIM as we start to look at it. So I don't think that distribution cuts are necessarily on the horizon. Again, a lot of the pain has been felt in the NAV or the price. And so the thing is that if those securities can still earn and you don't have a significant default wave, then I don't think distribution cuts are on the horizon for the industry as a whole. As those of you that follow our funds for a long period of time know that we made some adjustments to both DBL and DSL over the years to make them more market friendly, or things that didn't have to take egregious amounts of risk. And so that's actually benefited by us not having to distribute as much income. It means we didn't have to take as much risk coming into this part of the cycle. So that being said, you got to look at NIMs at the end of the day. I guess that's the word of the day, or the acronym of the day is NIM. Again, thoughts on copper gold versus the 10-year. It definitely is saying that rates should be lower, the copper gold ratio. This has been really copper falling out of bed. We saw this with most industrial metals being down in that technical bear market of more than 20%. I guess you could argue that oil's in a bear market too, although it sure doesn't feel like it because we're 20% off of its high that we saw in the year as well. But the copper gold ratio, it tends to be a direction. They don't always line up. We saw a big disconnect between copper gold for about 8-9 months in late 21 before rates kind of caught up. So we'll see if copper gold is signaling that recession, and that rate should be about, it does argue that the rate should be about 50 to 70 lower, which our fundamental analysis does not agree with at this point. Someone's asking about the management fee. The management fee has something to do with what's owned within there and the overall structure of the leverage in there. The reason that the most recent one is higher, it's because there's no load in those structures, and so the management fee is higher. Contact us fundinfo at doubleline.com if you want to get more of the details there. Any defaults? Nothing meaningful at this point within the portfolio. Again, as you noticed when I was talking about yields, I was talking about yield to maturity, but I was also talking about loss adjusted yield starting to haircut for some defaults and taking what we'll call below average severities, and there's how I'm thinking about that too. Have we had to sell to reduce leverage across the funds? No, it's all been by choice. Again, we have significant room in our leverage if we wanted to increase it at this point in time. But given how bad the breadth and momentum has been in some of these credit markets, we think it's just a little bit early to be nibbling there. We have done a little bit of rotation, but we don't want to nibble at the leverage at this point in time. Someone's asking about the best indicator for predictor of commodity prices. I'm going to punt that one to my colleagues, Jeff Mayberry and Sam Lau, on their podcast, Monday Morning Minutes. That is your question of the week, gentlemen. What indicator do you now think is the best predictor of forward-looking commodity prices? So I'll do that to them, and that will get you guys to listen to Monday Morning Minutes. That's released after the close every Friday. I'm more concerned what DoubleLine is doing about the poor performance. Well, as I showed you out there, the performance is significantly in line with the bond market. So I'm sorry you feel that way, but we are trying to do the best we can here. It's been a very challenging market out there. Unless you own cash, it's hard to not have a negative rate of return within the global fixed income markets. Someone's asking about the outlook for bank loans. Bank loans, we do think that there's going to be a higher defaults in this cycle than we've seen in the last one. We think severities will be a little bit lower. We think that the covenants aren't as big a deal as were made about post GFC. But what you've seen there is really it's a tale of what industry and what sector you're buying within those areas. So I think there's a lot made about bank loans that you cast the baby out with the bathwater. There's a lot of high quality stuff in there that's pretty favorable. The market's digesting a lot of LBO type activity right now that the banks are sitting on as well, that they're trying to get to the loan market. So there's likely to be a little bit of challenges in the short term. But as you can see here from our ownership, we're not that concerned about the aggregate bank loan market. Someone's asking about earnings versus distribution rates. I can't cover that. That's proprietary, unfortunately. That's confidential. But the dividends we are distributing out there, and so you can look at our semi-annuals to look at that. And then lastly, what is going on with the 20-year? Is it a technical? Well, yes. So there's a kink in the curve, I think is what someone's asking about. The 20-year bond has been outstripping the yield of both the 10-year and the 30-year, really the bulk of this year. And a lot of it's liquidity out there on that issue. And so if you look, the spread relative to like the 30 has been relatively constant. So what our folks are calling it internally is the illiquidity of that tenor of the curve that's driving that. So it's not that there's some arbitrage opportunity there. It's been persistent. It's been there for a while as well. Someone's pointing out that diesel gets better miles per gallon than unleaded gasoline. And I'll refute that with not when you're driving a recreational vehicle, as this person has done. So someone's saying, thanks for comments out here. I appreciate the time. Thank you, all of you, for listening today. Thank you for the support. I know it's been a challenging market. It's been difficult to own risk in these portfolios, in your portfolios this year. We feel very comfortable about the outlooks. It's going to be a challenging market until we get rate vol to settle down. There's likely to be more volatility in spreads. It's going to be a tough couple of weeks as we get through earnings. So just want to remind everyone why you invest. Remember your objectives. Remember out there, markets don't move up in a straight line. It takes some of this to flush out weak hands. But if you have marginal money to put to work, bond markets are really starting to look relatively attractive again. So thanks, everyone. Thanks for your time today. Thank you for your support, and bye for now.
Thank you. That does conclude today's webcast. We do thank you for your participation. Have an excellent day.